Good morning, traders. This is Michael and Paul coming to you from GammaEdge. Today, we're going to be discussing our workflow and how to go through a process to apply our GammaEdge tools and our data that we have in our Discord channel. Oops, there we go. All right, so GammaEdge disclaimer, stop and pause your player here. This is important to us. It should be important to you. All right, today we're going to go over our GammaEdge process, and we're going to just try to keep it simple for new members and actually existing members if they want to review this. So the first things we need to basically master or understand when you're looking at our data is the GammaEdge cumulative tick, and what is it telling us? This is our kind of market model that we model all of our trades against. The next question is what questions are addressed by the various GammaEdge levels? Number 3 is SPY, Q, or SPX. What GammaEdge levels are the ETF and index near? These would be larger liquidity levels that we look for possible price reactions. And 4, what causes a move in our GammaEdge levels? I'm going to go ahead and throw it over to Paul, and he's going to discuss our cumulative tick model.
Good afternoon, everyone. Yeah, the cumulative tick model, as Mike said, is really focused on keeping us on the right side of the market. We believe that if you can get the directionality of the main market identified and play against it, you're in pretty good shape. It'll be half of the battle. So I'm going to draw your eye, first of all, right here to where it says circle 1. The cumulative tick model here actually has 3 time frames that are indicated. And it's important for everyone to be able to think in these 3 different time frames, because depending on where we are and what they're telling you will depend on really how your exposure will be revealed, what you should be doing. And so I'm going to take you through kind of that development. We're going to start here at circle 1, which starts with the short-term trend. The short-term trend is when this white instantaneous, what we call the CT or the cumulative tick line, is above the shortest term moving averages. And the shortest term moving averages are shown here in white. Now we have an indicator here in TradeStation. We have one in TOS, which uses the same color scheme. And then we have one that one of our members, James, has developed in TradingView. It uses a different scheme, but the concepts are the same. Right? And one of the key things that you want to see here in a short-term trend is you want to see that the white line is above these short-term moving averages, and that ideally we actually see what we call railroad tracks. It's where you see they're starting to get parallel, they're separating, and things like that. So circle 1 here becomes that first step of when a signal starts maturing and when you can start doing something with it. Circle 2 here transitions us, excuse me, into a intermediate term trend. And this is actually a fairly simple thing to look at. All we're looking for here is that as this persists, it's going to move across what we call the ribbon. And the ribbon is a series of longer term moving averages. And all we're looking for is that the fastest moving, not delayed, cumulative tick is actually above that. And so circle 2, the test for that is simply, am I above the ribbon? And if the answer to that is yes, you're in a bullish stance. And if the answer to that is no, you're in a bearish stance. So with 1 and 2 now behind us, we move into the longest term part of the model, which is when we try to identify when a bullish trend is occurring. We're in one right now. You can see that this is literally yesterday's transactions. And the long-term trend is bullish when this red line, which we call the shortest term moving average, is above the cyan line. And this is in the ribbon here. What we'd like to see is that the slopes are all pointing lower left to upper right. So when we see that LLUR type of behavior, that lower left, upper right behavior, we have confidence that we're in a bull trend. So circle 1, again, we're looking for just the CT being above its shortest term moving averages. And you can see that occurred back here. 2, you can see that we're above the ribbon, and you can see that we had a reversal here. We went above the short-term short-term moving averages, which completes circle 1, and then we're above the ribbon, which completes circle 2. So you can see how this starts layering in day over day as we start looking at the data. And then circle 3, of course, is that we're in this longer term bullish trend to the upside. So as you step back, your actions are based with a bias to the long side with what we see on the screen here. Now I'm going to take you through, this is a continuation, right? This is a day over day type of phenomena. And what's really important here is that sometimes the signals in the short-term sense, they turn off. And when they turn off, there's things you probably should be looking at. So we were in a long signal way back here on the 25th. And, so we've got a little confirmation with the moving averages, the short-term moving averages kind of unwinding and starting that behavior, which we call railroad tracks or whatever the case may be. But you can see that the CT crossed it from above, and that actually tells us that that bullish signal, that the one that we were in, stops. So if you had profits, this would be an area where you would consider taking some profits or taking some positions off the table. You might leave some on, leave a trailer or whatever the case, because you are in a longer term bull. Just depends on when you got in, what the signals were, what your comfort level is, what your buffer is, how far up are you, etc. But then we see the CT line, the cumulative tick line, actually cross below, right? So it went up and then it crossed below, and now you can see we're starting this path down. When you start seeing this divergence away from the moving averages, that's telling you you've got a short-term bearish in an overall longer-term bullish cycle. That's something to read. So you've got multiple time frames to start looking at here. So your bias is still long-term bullish, but your short-term pullback. Okay, so we're coming down, and we're not going to talk about counter trade trends. That's kind of a popular thing in the Discord, in our GammaEdge Discord, et cetera. We're not going to talk about that right now, but you can see on the next day, we get a reversal. You get a crossing of the short-term moving averages from below. This would be your initial, okay, I'm going to get back in with a short-term position. And then when we cross above the upper moving average here, you've got another possible reentry site. And then when they unwrap themselves and start diverging like you see here, this is your confidence to get longer. So this is a progressive exposure model in an otherwise long-term type of bullish cycle. And we've tested this extensively with back testing and just with application, real world application. We've nailed this entire cycle literally to the day, literally intraday. A lot of folks are able to apply this, and I would urge everyone to to join us and make sure you understand this. It starts with this. This sets your bias. This sets what you're going to do. Yes, you might have a slight downward trend, that counter trend, but you're a counter trend in an otherwise upward long-term bull. Mike, did I cover everything that you wanted to cover there?
Yeah, absolutely, Paul. I think that's great. I think important there is the time frame matters, right? We've discussed that multiple times in our Discord. So depending on what time frame you're in and which signal you're looking at and what's your trading time frame. Yeah.
Okay, you go ahead and you can take it back if you'd like.
All right. Sounds good. So this is a market model via tick summary. These are labeled for your convenience there, so you can go ahead and check those out if you want to skip back to that chart. But basically what we're saying is instantaneous cumulative tick above the shortest term moving averages. And then you have the ideal railroad tracks, or however you'd like to classify that. But again, that's the short-term bull. That might be your intraday trading time frame or a 1 to 2 day trading time frame. Then we go to our intermediate term bull at number 2, as Paul laid out. So that's above those colored ribbons. Ideally, we have the railroad tracks. The angle of these railroad tracks is also important too. We want to see those, lower left, upper right, but the angle of ascent is can give us a strength indication of strength of the tick, and the tick is the overall institutions and what they're doing and how they're positioning in the market. And then below the CT slopes are positive. Long-term bull, number 3, that's our ribbon. So that would be the red above the cyan for an overall long-term bull. You want the CT obviously above the ribbon, and then the fastest MAs here. We kind of see the same thing, lower left to upper right pattern, and we want to see those slopes continue up to the upper right. And those are definitely important. Again, all that stuff is back tested, and we have excellent results, and there's posted in our Discord. So I encourage everybody to check those out. All right, so go ahead and moving forward. These are the questions that are answered by various levels. We continue to get questions, DMs and questions in the Discord about what these levels mean. So COI, call open interest, what strike of the entire complex contains the greatest number of calls? And conversely, the POI would be the put open interest, what strike of the entire complex contains the greatest number of puts? I think that's pretty self-explanatory and pretty easy for people. Positive GEX is positive gamma exposure. What strike of the entire complex contains the greatest positive gamma exposure? We've obviously color-coded these green for positive and red for negative, so those are easily visible. Those are also color-coded on our gamma scripts for trading view and toss that you can load every morning with the newest data. Negative GEX, what strike of the entire complex contains the greatest negative gamma exposure? Pretty self-explanatory. We call this positive trans or P-trans, positive transition. What strike of the entire complex and all the strikes above this strike are net positive gamma. And negative trans or N-trans, negative transition. What strike of the entire complex and all strikes below this strike are net negative gamma. These are kind of 6 very important levels. And then obviously the zeros we also watch also. Zero GEX, what strike is the balance point between negative GEX and net positive GEX. Again, if you want to pause those and review those. And I'm going to throw it over to Paul. He's going to kind of explain, these are our intraday charts.
Right. So we urge everyone to really limit their universe to, the SPY, the Qs, or if you're familiar and comfortable trading the SPX, which is, notionally about 10 times the size of the SPY, go ahead and do that. But, start small, of course, and start with something you're familiar with. And you don't need to look at the universe of stocks out there with options. You really only need to look at the SPY or the Qs or the SPX. And if you can make money with these, you can make money with stocks, much more rapidly. But you've got to establish somewhere. So our charts that are presented here, these are the minute charts. So this is an intraday from yesterday. OI is indicated, as you can see. It's got the date range, as you can see on here. And you can see that we break out those levels that Mike just covered. And why this is important is that this tells us what spot price is doing relative to these different levels. And when you run these in the Discord, you can run these real time. They're not delayed. All the information is there. We do get a delay on the SPX from the exchange. We have no control over that. The CBOE does delay that, but the Qs, the SPY, and all the stocks that we have access to are not delayed. They're all real time. So why that's important to us when we take a look at these levels is that we do overlay these levels, and you can see that price actually plays off these levels. We think that's very important. And you can look at the previous day, which is down here. So this would have been Thursday's action. Here's Friday's action. And you can see that these different levels do play a role, and they do help us look at our risk reward, what our entries, which should be, things related to that. So it's always important. And the key takeaway from this slide is to make sure that for the instruments you're looking at, whether it's the SPY, the Qs, the SPX, etc., make sure you know where some of these key positive levels are, because we're in a bullish cycle. So you want to understand where is P-trans, for instance, or where is plus GEX, or where is COI, or where are the zeros and things like that. And you can see on a day-over-day comparison, you have full access to this data within the charting. You can copy those charts and do whatever you want with them. Make your own records, make your own notes in your trading logs, etc. And you can start tracking the change of these things. There are other ways to track it. We have a history command, for instance, and you can watch the change of these commands. But the key takeaway is make sure you're very familiar with this. And if you're going to trade this instrument, that you know where those levels are. It's very, very important. Those levels address a specific question, as Mike covered. And you can see how they're overlaid here on the chart. Mike, is there anything there you want to say, or you want to continue on?
Yeah, we'll continue on. Great analysis there. So what causes a move in GammaEdge levels? this is extremely important, and we'll go further on a couple other slides, but a change in spot price, which spot price is dominant, a change in volatility, which is Vanna, minor compared to change in spot price, and a change in time, which is charm, minor compared to the change in spot price, but grows in importance as we near option expiry. And this is when your theta begins to kick in, the highest theta. Change in open interest, which is our expiry. Calls or puts being added, covered, or calls, puts being closed, sold, short. So these here I encourage everyone to review, because these is what causes our move and our change in gamma levels, and we should understand these intimately before we're looking at trading. Changes in COI strike. So this is call open interest, not spot price sensitive, and they're not time sensitive. Addition of calls above, which is below existing COI, will move COI upward, downward. Closing of calls at current COI may expose a new COI level. Option expiries often reveal a new COI. Conversely, with the changes in POI strike, they're not spot price sensitive also, and they're not time sensitive. Addition of calls below existing POI will move POI upward or downward. I think closing of calls at current POI may expose a new POI level, and option expiries often reveal a new POI level. Changes in positive GEX, large sensitivity to change in spot price. I think this is probably one of the most things I think is important about this positive GEX. Minor sensitivity to changes in volatility, and minor sensitivity to change in time except closer to expiry, which we've covered there. Addition of short-term calls above current strike will move positive GEX upward. Rolling closing of calls out in time at the same strike may move positive GEX upward or downward depending on structure as gamma reduces as time increases. And Paul's going to go over these coming up on some actual charts, so you'll be able to review these and understand these and pause and go back. Short-term calls added out in time and up in strike is considered bullish, as it reveals expectations of the market to profit as price moves upward. And we discuss this all the time about if we want to see a sustained move up, we want to see calls building up and out. We say that multiple times, up and out, and we're going to show you what that means and describe that. Conversely, change in negative GEX, large sensitivity to change in spot price, minor sensitivity to change in volatility, minor sensitivity to change in time except closer to expiry, which those are both for negative and positive GEX. Addition of short-term puts below current strike will move negative GEX downward. Rolling closing of puts out in time at same strike may move negative GEX upward or downward depending on structure as gamma reduces as time increases. Short-term puts added out in time and up in strike is considered bearish, as it reveals expectations of the market to profit as price reverses. All right, Paul, go ahead and take it away and discuss those key concepts.
Yeah, so same charts that we were looking at before. And if you notice, we actually get a transition from a plus GEX from 405 up here to 410. And so with what Mike just covered, what causes a change in that plus GEX? Well, there could be a couple things. In this particular instance, the movement of spot price has a role here, of course. So as price goes up, gamma changes, and we're going to see a little bit from that. But also, we're seeing the market expectation and their opening calls up and out or up in time, or up in strike, and this is moving the spot price up, or moving the gamma level up, this plus GEX level up. And so when we see that, it's an expectation that as price moves up, that these people are going to play the convexity, the gamma in those options. And so what we end up with here is that when we see this day over day change in the overall dominant gamma levels, we're able to play on that. We're able to see that. And we have the ability to look ahead and see some estimations of what happens with various expiries. For instance, as you guys probably know, the SPY expires Monday, Wednesday, Friday. So we can actually look ahead and see what are the implications there. And then we can also run at various prices. We can put a price in if we wanted to see what would be the new levels from 410 to 415, for instance, on the SPY, et cetera, and see how the structure changes. And so there's a lot of flexibility available to you. The key takeaway is that these levels provide us some reference points, and you can see how we have moved upward, both on the plus GEX level. You can see the COI level moved up. And remember, the COI level is not a gamma phenomena. The COI level is purely answering the question, at what strike in the complex do we have the maximum calls? And this gives you confidence that calls went out or up in strike and were added. And when we see calls added to the complex, we're confident that the market is positioning, that they're building new positions, and typically price goes where gamma is going. So if we take a look over here at the Qs, kind of the same thing. You can see 2 days ago we had plus GEX at 310, and now we're up at 315 with the close yesterday. And then over here on the SPX, we had a plus GEX at 4,100, and now we're up at 4,200 as of yesterday's close. So, the real key takeaway, I think, here for this is that we're able to watch these moves in these levels. If you see this, you're able to have an expectation when you combine this with the market model that in this particular case, that the bullishness will continue until it doesn't, right? And so this helps you analyze what is the market doing and what is the likelihood that we could advance upward. So with that, Mike, I'll pass it back to you for the wrap up.
All right, sounds good. So an overall GammaEdge process summary, master the first before expanding your scope. And I think this is extremely important for new traders coming in, or even traders that have traded a different trading style and they're looking to move to a kind of GammaEdge base style. And so again, GammaEdge cumulative tick, what is it telling us? Where are we at in those time frames? Is the market model in an uptrend or downtrend? That will keep you on the right side of the trade. I mean, I think that's 50% of the battle for most of us. What questions are addressed by the various GammaEdge levels? Again, go back and review those and understand what is happening when COI moves. What is happening when POI moves? What is occurring, and what can that tell us for moving forward? And what can we anticipate was going to happen in the overall market structure? SPY, Qs, or SPX, what GammaEdge levels are the ETF or index near? Again, what are those large levels where we anticipate some type of price reaction and there's more liquidity there? Are there calls? Are there puts? What does that structure look like? And you're able to participate and put risk reward trades on. What causes a move in the GammaEdge levels? Again, understanding what is happening and what is occurring.
Right. Great. So in wrapping up here, we hope that this helps establish a foundation for your process flow. I think it's important to adapt this core process and fit it in with your style of trading, with investing, with taking a look at the market. We do this every day, and we have a very active Discord. I would urge everyone, come join us at www.gammaedge.us. You can see it here on the screen. That'll take you to a sign-up page. Click the pricing tab on that page, and then once you complete that, that'll get you into the Discord. 14-day free trial. All the tools turned on. We just showed just a very high level of some of the charting capabilities and the analysis capabilities. There's so much more under the engine there that you can use to really start drilling down into this stuff. Of course, follow us on Twitter, GammaEdges with an S, and then finally here on YouTube. If you like today's content, let Mike and I know by smashing that like button. And of course, if you're not a subscriber, we ask that you do subscribe so you can get notified the next time that we add content to this. So with that, Mike and I will bid you farewell. We hope to see you in the Discord. Come armed with your questions. We you welcome them. It's a teaching environment. We're all about how do we become better traders, better investors, and there's a lot of capability here that I think everyone can leverage. So with that, I will bid you farewell. And Mike, any last thoughts?
No, hope to see everybody in the Discord. It is a great community, and so come join us.
Great. All right. Take care, everyone. Bye.